Hey, welcome to Belize Crypto Network channel, the #1 place for crypto education for the Belizean and Friends community. And here we explain topics of the cryptocurrency world using analogies, stories, and examples so that you can easily understand them. In this video, we're going to explain what KYC is, why they do it on exchanges, the levels of KYC, the pros and cons of it, examples of KYC exchanges, and then examples of non-KYC exchanges. So let's dig in. First off, let's start with the definition of KYC. KYC stands for Know Your Customer, sometimes Know Your Client. It's a process that businesses, especially financial institutions like banks, crypto exchanges, or investment platforms, use to verify the identity of their clients. The main goals of KYC are prevent fraud, making sure someone isn't pretending to be someone else. Stop money laundering and terrorism financing, ensuring funds come from legal sources, comply with regulations. Most countries require it by law. KYC usually involves personal information, name, date of birth, address, contact details, identity documents, passport, driver's license, national ID, or sometimes utility bills or bank statements, biometric checks, selfies, facial recognition, or fingerprints in some systems. In crypto and fintech, KYC is often tied to AML, anti-money laundering rules, so you'll hear the two mentioned together, KYC, AML. Now let's get into why crypto platforms use KYC. There are three main reasons for this. First, regulatory compliance. Governments require exchanges and wallet providers to verify customers to prevent money laundering, tax evasion, and illicit use. Second, security. It helps protect against fraud, account takeovers, and scams. Third, trust and legitimacy. Platforms with KYC are usually seen as safer and more reputable. Next, let's talk about the typical steps of KYC when signing up for a crypto exchange. Step 1, sign up. You create an account with your email or phone number. Step 2, identity verification. The platform asks for documents like passport, driver's license, or national ID, a selfie or short video to prove it's you. Proof of address, utility bill, bank statement, or government mail. Step 4, approval. This can be automated or manually reviewed by the exchange staff. Step 5, access granted. Once approved, you can deposit, trade, and withdraw larger amounts. After this, there are normally different levels of KYC. First, no KYC. Some exchanges allow you to open an account and trade small amounts of crypto without providing ID. However, you'll likely face very low withdrawal limits, and it's probably best to use these only to test out the platform. Next, basic or intermediate KYC. This is the most common level where you provide your ID and a selfie. You may also need proof of address. On this level, you'll have higher limits than the no KYC level, but not as much as the advanced level. Finally, advanced or complete KYC. This might include a video call, proof of income or funds, and other extensive checks. With this level, you'll have unlimited or institutional level trading. Now let's go over the pros and cons of KYC. Starting with the pros, it builds trust between the exchange and the user. KYC helps establish trust between the crypto exchange and its users. By verifying users' identities, exchanges can build confidence in the legitimacy of their customers, which helps create a safer trading environment. It prevents fraud, scams, and account takeovers. KYC procedures help prevent fraudulent activities, scams, and unauthorized account access by ensuring that only real individuals with verified identities are allowed to trade on the platform. It increases transaction and withdrawal limits. Exchanges typically impose higher transaction and withdrawal limits on verified users, as they pose less risk to the platform. This allows users to trade and transfer larger amounts more easily, meets legal requirements, and reduces the risk of shutdown. KYC is often mandated by regulators, and exchanges must comply with these regulations to avoid penalties or closure. By adhering to KYC policies, exchanges can mitigate legal risks and ensure smooth operations. Next, let's discuss some of the cons. One is that it reduces anonymity. KYC protocols go against the traditional anonymity and pseudonymity associated with cryptocurrencies. By revealing their identities, users may compromise the privacy and confidentiality that initially attracted them to crypto. Another one is the risk of data leaks. Centralized exchanges that collect sensitive user data through KYC procedures are vulnerable to data leaks and breaches. The security of user information must be robustly safeguarded to prevent unauthorized access or disclosure. And lastly, it can exclude users in regions with poor ID systems. In regions where obtaining proper identification documents is challenging or impossible, KYC requirements can hinder individuals from accessing crypto services. This creates a barrier to entry and limits financial inclusion in underserved areas. Next, let's talk about KYC platforms, which are centralized exchanges, CEXs, like Binance, Coinbase, Kraken, or Crypto.com. These exchanges require government ID, a selfie, and proof of address to create an account. Most of these platforms are fully regulated in most regions and allow you to buy crypto directly with cash via bank transfer or card. Here's some pros and cons of these types of exchanges. Starting with the pros, it's safer against fraud and scams. Because of the strict verification process, these exchanges usually have better security measures in place and are more protected against hacks and cyber threats. They're easier for beginners. KYC exchanges often provide a more user-friendly experience for beginners by guiding them through the verification process and offering hand-holding support. It's simpler to buy crypto with fiat currency. These exchanges usually offer direct fiat on-ramps, allowing users to buy crypto using traditional currencies, such as dollars, euros, or local currencies. Lastly, they have access to fiat banking. Users can link their bank accounts to the exchange, enabling them to transfer funds back and forth between their bank accounts and their exchange accounts. Now let's talk about the cons. The biggest one is that you lose privacy and anonymity. By providing personal information and documentation during KYC, users sacrifice a degree of privacy and anonymity, which is a core aspect of cryptocurrencies. Governments can freeze or track funds. In some cases, governments or law enforcement agencies can request exchanges to freeze user funds or share transaction data, potentially compromising user privacy and financial autonomy. Data breaches are a risk. Centralized exchanges holding vast amounts of user data are potential targets for hackers. Data breaches at KYC exchanges can expose sensitive information, including names, addresses, and identification documents, putting users at risk of identity theft or other security threats. Lastly, these exchanges sometimes exclude people in restricted countries. Due to regulatory restrictions and sanctions, some countries may find it challenging to access services on KYC exchanges, limiting their ability to participate in the crypto market. Moving on, let's discuss non-KYC platforms or anonymous exchanges. These are decentralized exchanges, DEXs, like Uniswap, PancakeSwap, DYDX, or privacy-focused services. When you use these platforms, you connect your crypto wallet, like MetaMask, Trust Wallet, or Phantom, and trades happen directly between wallets on the blockchain. No company actually holds your funds. Here are some pros and cons of non-KYC exchanges. First, let's go over the pros. You maintain full privacy and anonymity. Users can transact without revealing their identities, preserving their privacy, and allowing them to engage in the crypto market without public scrutiny. You keep control of your funds at all times. Since transactions occur directly between wallets without intermediaries, users maintain control over their assets. You can transact from anywhere in the world. Without geographical limitations, users can access decentralized exchanges and trade cryptocurrencies from anywhere, fostering a truly global and borderless financial system. It's usually faster to get started. Unlike KYC exchanges, non-KYC platforms often have no waiting periods for verification, allowing users to create wallets and begin transacting instantly. Now let's discuss the cons. There's a higher risk of scams and rug pulls. Without the safeguards of KYC procedures, decentralized exchanges may face a higher risk of scams, fraudulent activities, and projects pulling the rug, leaving users vulnerable to malicious actors. There's no customer support. If something goes wrong, since non-KYC platforms are largely decentralized, users may not have a central authority or customer support to turn to when facing issues or seeking assistance. There's no fiat on-ramp. You need crypto to trade. To use non-KYC platforms, users must already possess cryptocurrencies, which may pose a barrier for individuals looking to enter the crypto market without prior investments. Some non-KYC DEXs are blocked in certain countries. Depending on the jurisdiction, some decentralized exchanges may be blocked or restricted, limiting access for users in those regions. To sum it all up, whether to use a KYC or non-KYC platform depends on your needs and priorities. KYC exchanges provide a secure and regulated environment with easy fiat on-ramps but compromise privacy. Non-KYC platforms offer anonymity and decentralization, but may lack security and fiat accessibility. Choose wisely based on your comfort level, with risk and desired level of privacy. As always, we hope that you've enjoyed this video. We really hope that you've learned something, and most of all, we hope to see you in our next videos.